Welcome to the next edition of the monthly housing chart pack by Cotality from the month of July 2026. I love going through these reports. There's a lot of data to unpack. These videos are usually a little bit longer, but I hope you guys get the value out of it that what I do when I go through this report touches on a number of different things, and let us break it down. The first thing we want to touch on is the auction clearance rates are losing their shine as buyers shy away. Now, auction clearance rates are a very good indicator of sentiment. When sentiment is pumping, money is flowing, auctions are packed, people are bidding, people are getting emotional, and they are paying overs for property. On the flip side, when sentiment is low, auctions have less people, they're quieter, people are more dubious, and they think twice before they put up a bid, and they are more apprehensive to attend and apprehensive to bid. And we can see here that the auction clearance rates have dropped dramatically, especially on the East Coast, where Sydney and Melbourne generally lead the way in terms of auction clearance rates. You can see here there's a sharp decline in monthly auction numbers, outpacing the drop in listings. So this is a good indicator for us as to where sentiment is across the country, especially in our two most expensive markets of Sydney and Melbourne. Now, just a quick overview, and we've all seen this graph before, but a quick overview why I don't believe that we are going to have the property crash that a lot of pundits are talking about, 30-40% correction. And that is simply because Australian real estate is worth 12.5 trillion. The outstanding mortgage debt across the country is 2.6 trillion. Therefore, we are in a very, very healthy LVR position as a country, and real estate still remains the backbone of wealth in Australia. So I don't believe we are going to be seeing that crash that a lot of people are probably hoping for, and that a lot of spruikers are talking about in the media. Now, Australian housing values, there is no doubt about it, are softening, and capital city growth is softening, and even regional areas are softening. There is no doubt about that. And you can see that in the last 3 months, Australian home values decreased 0.7%. Remember, this is a median figure. We are not talking down to a state, LGA or suburb level. And you can see that the 12-month growth across the country has de-accelerated to 7.3% as buyer demand and monthly gains lose momentum. And I believe, remember, property is not it's not a fluid asset. It's not a liquid asset. It takes a long time for momentum to change one way or the other. So I believe we're going to continue to see softening prices for the next quarter or two at least. Regionals versus capitals, uneven quarter for dwelling capital gains. So regional areas are outpacing capitals with values rising 1.1% against a 1.3% fall in combined capital city values over the June quarter. So again, we know that regionals are performing better than capital cities, and a lot of that comes down to affordability and yield. Now, if we look at the 3 monthly changes to June 2026, you can see that regionally, every single region has gone up in value, even as small as 0.2% in regional New South Wales, all the way up to 3.7% in regional Western Australia, which is still performing quite strongly, followed by regional Tasmania at 2.8%. Now, if you look at the capital city side, you can see that Darwin is steamrolling ahead. It's done 5% growth in the last quarter. And you can see Perth 2%, Hobart 1.4%, Adelaide and Brisbane 1.3%. And then on the negative side of the spectrum, you've got Sydney, Melbourne and Canberra all retreating, and they are slipping into the negative. So we are definitely seeing markets correcting within Sydney, Melbourne and Canberra at this point in time. And on the right hand side of your screen, you can see the combined values of both capital cities and regionals, and you can see that they're both in a downward trajectory. However, the combined capitals has gone below the zero line, the break-even line, and is now heading into negative territory. Panic stations, you say? I say no. I say opportunity. This is a moment in time that we will look back on, and we will either be fond of ourselves for taking the opportunity and going against the herd and against the sentiment, or we will be kicking ourselves for not taking the opportunity. And before I continue, I just want to remind everyone that we have a newly formed community. The link is in our bio on YouTube. Jump into the community, join the investors that are in there. I am in there. We are very active. We do a lot of due diligence, a lot of commentary around different markets, and we are there to help one another grow, share information, use data, and propel each other to continue to go forward. And like I always say, there is no lock-in contract. There is a free 3-day trial for the first 10 members, and it is a monthly cost of $8.99. And if you don't like it after the first month, you can leave, and there is no lock-in contracts. Now, if we look at the 12-month change in values, we're going to see these figures continue to soften as the months roll by. But you can see in the regional side that all of the regionals have recorded 12 months growth. Regional WA leads the pack at 22%. Regional Tasmania coming in at a close second with regional Queensland. But I do believe we're going to see those values soften as the months progress and the sentiment continues to dip. On the capital city front, now we are still capturing data from the last 2025 and early 2026, where we're still having good price growth momentum. So a lot of this data is still going to look strong on the capital city front. However, as the months roll on, I believe we're going to see those numbers soften across the board when we look at the values over a 12-month period. Now, on the capital city front, if you look at these line graphs, you can see every single capital city, barring Darwin, is on a downward trajectory. Now, you can see that Sydney and Melbourne are below the 0% line, the break-even line. They are heading into negative territory. You can see Brisbane and Adelaide, which I believe, in my opinion, have peaked or very, very close to the peak, but I believe they've peaked and they are now regressing. Although they are still recording some growth, they are regressing and heading towards that 0% line, as in the last quarter, prices have definitely softened. I believe we've hit an affordability ceiling in those capital cities. Now, on the right-hand side of your screen, you're going to see every single state, Perth, Hobart, are also heading in a downward trajectory as prices soften. Canberra is following the same trajectory as Sydney and Melbourne and into the negative territory. And Darwin is still moving up, albeit in the last month it might have flatlined slightly, but it's still recording some serious growth over the last quarter. But you can see here holistically that all of these states are experiencing price softening across the board in their capital cities. And it's no wonder with the significant price growth that's been had in the last 4 or 5 years. Now, I love this chart. This provides a beautiful breakdown of every capital city and it has its property markets divided into different segments. You've got your most affordable segment in the red, you've got your middle value segment in the yellow, and you've got the highest value segments in the purple. Now, if you look at Sydney and Melbourne, you can see that every single market segment is losing value. It is correcting, especially the markets that are in the highest 25% of values. They are being hit the hardest with this negative sentiment, especially post-budget. But you can also see that the middle 50% of values tier is also correcting, and the cheapest markets are also correcting. Now, again, for me, when I look at these, I will look at, especially in the lowest 25% value markets, for me, there is some great opportunities when you're looking and you're seeing these sort of figures. If you cast your eyes across the rest of the states, you can see, excluding ACT for the moment, you can see Brisbane, Adelaide, Perth and Hobart are still recording their strongest growth in the lowest 25% quartile of their property markets. So again, that tells me that there is a flight to affordability, and it is the affordable segment of the market that is continuing to experience the best growth. And in times like this, it's no surprise to see the most expensive segment of the market featuring the weakest growth, albeit still growth. Now, if you look at Darwin, Darwin is in a world of its own. It is recording some serious growth in the last quarter in all three ranges of its markets, the cheapest, the middle, and the most expensive. So again, Darwin is on its own race, and ACT is following the same path as Sydney and Melbourne, and it is correcting across the board, and values are retracting in those markets. Now, if we look at the housing cycles, you can see here the rolling 28-day growth rate, Cotality home value index, is indicating to us that all capital cities are on a downward trajectory. Now, you can see here that all of the capital cities are losing momentum, and Perth remains the only capital city where growth is still evident, albeit that is also softening. And you can see Brisbane and Adelaide values are down slightly, 0.2%. Sydney and Melbourne have weakened further, with values for both capital cities down 1.2%, 1.3% respectively, making them the weakest performing capital cities. Again, if we go up one, you can see that in my eyes, when I look at this, I say, well, there is some serious opportunity in the 25 lowest 25% value sector in these markets. There's going to be less competition. Sentiment is negative. It might be a good time if you buy in the right market now. You're going to be competing against less investors, less buyers agents, and you could get yourself a very good deal potentially below market value. Now, this just gives you a housing cycle breakdown of the state by state in June. I'll quickly breeze through these, but you can see in June, Sydney dwelling values were down by 1.2%. Melbourne values were down by 1%. Brisbane values were up 0.3% in the month of June. So again, you can see that growth is definitely softening. Adelaide, dwelling values in Adelaide were unchanged in the month of June. So again, I believe we've hit a affordability ceiling. I believe we've hit a peak in the majority of Adelaide, and we are now seeing values remain unchanged, hovering around that break-even point, and I believe we will start to see a slight correction potentially. Perth values were up 0.7% in the month of June. So again, we're not seeing the 2%, we're not seeing the high 1%, but we are still seeing some growth happening in Perth, and that is underpinned by the complete undersupply of stock in that market. Hobart again doing quite well, recorded 0.6% growth in the month of June, and we know Hobart is definitely performing very well now in both the regional and the capital city front. Darwin recorded the strongest growth in the month of June at 1.4%. Darwin is on a fantastic run. Still a very transient market in my opinion. You've got to be very careful when you invest in Darwin, but it is performing very well, and if you're smart about it, you can definitely make some good money. Canberra, values are retracting there, and that retracted 0.6%, and definitely in a correction period in Canberra. Now, if we look at the sales listing across the country, you can see that national home sales rose 2.1% over the year to June 2026. With growth concentrated in regional markets, the number of sales across the combined regional areas increased 7.2% year on year, while the combined capitals eased 0.7%. The deterioration in demand since late 2025 is clearly evident, with sales volumes now tracking below the 5-year average. So you can see here on the right hand side, you've got your 5-year average in the black line, you've got your monthly sales volumes and your 6-month moving average, and they're both trending below the 5-year average. Now, the changes in selling volumes for the last year to the end of June 2026, you can see it's no surprise to see regional Northern Territory and regional Victoria really experiencing a lot of sales. We know that regional Vic was getting smashed by buyers, agents and investors, and so is regional Northern Territory. And you can see that regional WA and regional Queensland are on the other side of the spectrum with less sales occurring there. And on the capital city front, you can see that there is a few sales happening across some of the capital cities. Darwin, 17.8% of sales occurring there in the last year in terms of changes to selling volume, so we can see a lot of demand going in those areas. Perth, capital city, has had a lessening of sales volumes in the last 12 months, so a lot of stock either coming off market or not being sold at the moment. Median days on market is another very good indicator of demand, and we have a nice regional and capital city breakdown. And you can see it's a comparison from June last year in purple to June this year. So we can see that June this year in the blue, a lot of these regional areas have less days on market, which means demand is higher than at this time last year. So you can see that in regional Northern Territory, regional Tasmania, regional WA, still a very hot market. Regional South Australia, all of those regional areas are hotter in terms of less days on market. Now, regional Queensland is 28 days on market now compared to 24 last year. So still quite similar, only a 4-day difference, but it's a bit of a potential indicator of where the demand is going in regional Queensland. Regional Victoria has experiencing less days on market now, as is regional New South Wales. And I believe regional New South Wales, we will see that data really start to improve in the next 3 to 6 months, because there's still a lot of value happening in that part of the country. Now, on the capital city front, you can see that, again, Darwin is a lot hotter now than it was this time last year. Hobart is very similar. Perth is very similar. Adelaide is actually hotter now in terms of days on market than it was this time last year. Brisbane, similar. Melbourne and Sydney, both similar as well, albeit that both Brisbane, Melbourne and Sydney have slightly higher days on market now than they did this time last year, which is no surprise when you look at where they are in their market cycle position. Vendor discount is also another good indicator of demand and sentiment. When you have very high sentiment and the market is pumping, and it's a seller's market in terms of you put your property on the market and people are just going to outbid one another and get it, then you see no vendor discount happening. On the flip side, when you see quieter markets and properties are staying on the market longer, days on market are starting to increase, that's when you may start to see vendors take a bit of a hit and start to either reduce their advertised price or willing to negotiate more with a potential buyer. So that is another good indicator to us of where sentiment is sitting at the moment. Now, flow of new listings. This is important for us to see where supply is at. So new listings track closely within the 5-year average for the first half of the year and remained above 2025 levels for most of the year. Listing activity has softened from a peak in early March, trending downwards through winter, closing 2.1% above year ago levels and 9% below the 5-year average. So again, we can see that the purple line of 2026, it is trending away from the previous 5-year average, meaning that listings are dropping, and there is still pressure on the housing market in Australia because there is simply not enough supply and there is simply not enough listings coming online. On the total listing front, you can see that total listings commenced 2026 well below year ago levels and began to rise steadily throughout the first half of the year. Now that would have come off the back of expected budget changes, higher interest rates, interest rate hikes, geopolitical tensions adding to cost of living expenses. So a lot more people would have potentially been forced to sell or would have cut their losses or wanted to bank their profits and listed their property for sale. You can still see that we are 3.7% below the 5-year average in early July. With total listings up 8.4% on year ago levels, the trend is showing a steady rise in listings at a time when buyer demand is easing. So what does that tell us? That tells us two things. Total listings across the country are rising. Buyer demand across the country is easing. So that is no surprise to see that a lot of these markets are experiencing softening growth because the enemy of capital growth is supply. Now you've got two things working against capital growth. Now you've got increasing supply and decreasing demand. Those two metrics combined, simple economics, means that the housing prices across the country, the housing markets are softening, and we can see that reflected in the data. Again, you can see here listings by region. There's another good breakdown to see where people are buying, where the demand is. So you can see new listings in the capital cities are 2% higher than compared to last year. Most cities have seen an increase in the flow of freshly advertised stock relative to a year ago, although new listings in Sydney and Hobart are down 8.2% and 9.6% respectively. Now that's quite interesting. Now, Hobart, I can understand that listings are down because Hobart is, a state that is doing quite well at the moment, but Sydney listings are down as well. So what does that tell me? Well, I interpret that in a number of ways. Number one, people that don't have to sell will potentially hold through this period and not sell. Number two, a lot of people may be seeing an opportunity and maybe trying to ride through this lull and try and come out the other side with their properties intact and capture the growth that will inadvertently come from that. Now, total advertised stock across the combined capital sits 15.9% above year ago levels, led by more and more substantial lift in Brisbane, Adelaide and Melbourne. So again, we can see that in a lot of these capital cities, people may be feeling the pinch from the post-budget changes. People may be buying into the negative market sentiment, may be worried. They want to bank their profits before this softening market continues and really starts to take a hold. So we can see an increase in listings across the board, which is, again, quite interesting to see. And you can see on the capital city front, new listings changed from equivalent period last year. So Sydney and Melbourne listings have dropped, albeit in other capitals, Melbourne, Brisbane, Adelaide, Perth, listings have increased. Regionally, regional Victoria, you can see listings have really gone up there, as is regional Tasmania. So again, people want to cash in on the demand in those areas. And like I've said in previous videos, there are areas in regional Victoria that are growing. You look at Latrobe Valley, you look at Morwell, for example. That suburb has done 27, 28% growth in the last 12 months. There's other areas, you've got your Sheppartons, you've got your Bendigos, you've got your Ballarats. They are really doing well. So again, despite the doom and gloom of the headlines, there are still areas that are growing and growing steadily. And you can see on the regional front, listings have dropped in all of the major regional states except for regional Queensland, where listings have increased. But you got to remember, regional Queensland has done some phenomenal growth, and there may be a lot of people now hit that ceiling or want to repurpose that capital, bank their profits and move into other markets. Rental market. In our rental market, you can see here that vacancy rates are still very tight across the country. So rents have grown circa 6% to June 2026, up from mid-2025's low of 3.4%. And I believe we're going to see these numbers exasperated post-budget as rental stock gets depleted and rents continue to increase. Now you can see regionally rents have gone up and have gone up substantially. Look at regional Tasmania, rents went up 10%, regional WA 8%. So, and the rest of the regions have gone up, 6, 5, and the lowest increase there was regional Victoria at 4%. On the capital city front, we've seen rents increase across the board. Darwin rents have gone up 10%, which is massive. Hobart rents, which has a very, very tight vacancy rate, is up 8.6%. Perth vacancy rental increases are up 7.8%. So again, I believe this problem is only going to get exasperated and we're going to see rents continue to skyrocket. Now, yield is an interesting one for me. I'm really looking forward to see how this information transpires over the next quarter or 2 quarters. I believe with softening price growth and increased rental pressure, which is going to translate into increased rental prices, we are actually going to see yield start to recover and yield start to look more attractive. And once we see yield start to really get to that mid-4s, especially in the capital cities towards that 5, that's going to attract a lot of investors to come back into the market, and we're going to see the cycle start to repeat. But you can see regionally that yields are hovering in those 4s, barring regional WA and regional Northern Territory. And on the capital city front, because of the incredible price growth that's been had over the last 4 or 5 years, yields have really compressed, and most of the capital cities now are sitting in that mid to low 3%. So again, I believe we'll see that change as house prices continue to soften and rents continue to increase. A couple more slides to touch on before we wrap this video up. Just wanted to look at the dwelling approvals. So you can see that unit approvals dropped to 6,300 in May 2026, down sharply from February. And you can see that a big reason is the construction costs continue to go up, making it less viable for builders and developers to kickstart those projects. Quarter-on-quarter commencements fell 11.2%, led by a 19.8% drop in apartments, with house commencements declining by 3.6%. So not only do we not have enough supply in the market, not only do we have enough rental stock in the market, not only is immigration continuing to ramp up and produce big numbers of new people into this country, we are not even approving enough property. Construction costs are soaring, let alone, don't worry about completion, we're not even approving enough dwellings to even get projects started. So this is why I believe we're not going to see a 30 or 40% correction. We have a fundamental problem with supply in this country, and that is going to maintain a floor under house prices. Finance and lending, it's quite interesting to see where the money is going, and it's a nice state-by-state breakdown. So we're excluding refinances from these figures, but basically you can see from a peak in December 2025, the value of home lending fell 3.8% in the March quarter. The decline was broad-based across borrower types, but led by owner-occupiers ahead of investors. So you can see owner-occupiers are generally more sensitive to interest rates and high cost of living, whereas investors look at things from a different lens. It'd be interesting to see what the data comes out in the next couple of months post-budget, but you can see that the quarterly value of new finance commitments, excluding refinancing, as breakdown state by state, you can see that investors are still borrowing a lot more than owner-occupiers in a lot of these states. New South Wales, 29%, Vic, 40% lending by investors, Queensland, 31%, South Australia, 22%, WA, 30%, Tasmania, 73%. Of lending in Tasmania is happening by investors. That's another topic for another video. That is why I believe that the Tasmanian price growth is very, very investor-led. That's not to say you're not going to make money, but you just got to be careful that it is very investor-led. But that's another good indication. Follow the money. We've all heard that saying, you follow the money, and you can see where in every state investors are still lending more than owner-occupiers. And you can see this breakdown here from the last 10-year average and where investor lending is at, and investor lending has surpassed every single state last 10-year average, and in some areas it's really almost doubled it, like Northern Territory. You can see that investors are taking up a massive share of lending in every state, in every capital city, and it is outdoing the entire 10-year average across every single state in the country. Finally, RBA held the cash rate in June at 4.35%, which was quite expected. I believe we may be in for another couple of holds this year, with potentially one more rate rise depending on what happens in the Middle East and the war over there, how that's going to affect fuel prices and how that's going to affect inflation. But at the latest RBA meeting, they decided to hold interest rates. It'll be quite interesting to see what they do in the next meeting. But at this stage, they held it. Now, interest rates, just to touch on and summarize this video, interest rates is just one component when you look at the, property market and property investing. It's something you've got to factor in as a sophisticated investor. You've got to have your buffers. You've got to stress test your portfolio by a couple of extra percent to what the current interest rate is now to see if you can withstand these periods of higher interest rates. I would not let that dictate whether I buy or not. Interest rates is something out of our control. If you have the right financial buffers, if you have the right advice, the right team, if you join All Things Property Oz community where we discuss these sort of things and we have a dedicated channel talking about interest rates, you will get a lot more confidence. Knowledge is power. If you train yourself, if you educate yourself, if you surround yourself with the right team, you will do well. Guys, I hope you enjoyed this video. I hope you got some good value from this video. Don't forget, please like and subscribe this video. Join the channel, join the community, and we look forward to seeing you on the next one. Till the next one, take care.